Markets have not fallen apart. All right, we've come down from the recent high, but it's not that we are at the beginning of a bear market or everybody's feeling very nervous about it. Are you somewhere secretly surprised with the resilience what India has suggested?
Undoubtedly, Nikunj Bhai, the amount of money which domestic investors have invested in markets during this downturn is truly amazing. In March and April 20, FPI sold 69,000 crore worth of equity, and markets were down about 35% from 12,300 to 7,500. From October, they have sold 1,50,000 crore plus, roughly 2 lakh, and markets are down only 10-11%. One, FPIs have become smarter from their experience in March and April 20. And second, retail investors are showing tremendous maturity for the growth story of India. And partly, Nikunj Bhai, credit goes to you.
For the first time, somebody is saying media has done a great job.
Because now you are also saying that you don't have to talk about SIP. It's already sold to every investor. And the job which, Nikunj Bhai, you have done popularizing SIP and equity to retail investors, I think that's also playing a great role in getting informed investors into the market.
But will the SIP investors be disappointed or will they be rewarded from here?
So every SIP investor will have to go through Agni Pariksha. In March 20, the Agni Pariksha was huge. 3 years equity SIP returns were negative. 5 years equity SIP returns were lower than savings bank account. And 10-year equity SIP returns were lower than bank fixed deposits. To pass through that Agni Pariksha, today are seeing double-digit return across 3, 5, and 7 and 10 year. So Agni Pariksha to deni padegi. Jo pass hoga, he or she will enjoy the return.
Madhu Bhaiya, what do you want to start with? SIP?
You have become so smart now that I can't put a question to you.
Sir, panel is about you guys, not about me.
Yeah, no,
sir, mere piche pade aaj.
Whatever, tere ko jo question puchna hai, puch.
My question for the larger audience here is, we have seen this big change, and this is something I want to bring out for the audience here as well. There was a time when FIs would sneeze and markets would catch a flu. The number which we would always look at is that what was the FI selling. But the number which we get very happy about in the morning when we start our show is what domestic institutional investors are doing. This is a mega trend. But is this mega trend here to stay? Because for the first time, so the temperament will be tested. If you came after COVID, you made money. Now the heat is going to be felt.
I would say, Nikunj, this is definitely here to stay for multiple reasons. A, the number of investors participating in India has gone up from, let's say, 2, 2.5, 3 crores to roughly 9 crores today. Abhi logon ko khoon lag gaya hai, in last 2 years. And I do not think it is, as many people call it, a sucker's rally. It doesn't look like one, at least to me. So this domestic money is here to stay. Because when we look at the domestic money, the context of our GDP, the absolute saving, and still the amount of money which is coming to retail public, there is still a disconnect. And second point is, where are the alternatives? If I'm not doing equity, what do? I get 5% in a bank deposit. If I pay 35% tax, then I'm actually decreasing my money, like not increasing it. So I can put some in gold, I can put some in property, but ultimately equities will have to be the answer. That's one. That's the point number one. Point number two, that when I look at the absolute size of GDP and absolute saving, still the money looks small. And the third and the biggest point, when we see the investor go up from 3 crores to 9 crores, we are all getting excited because it has happened in a short period of time in COVID. But let's remember there are 140 crore people. What stops that this number in 5 years' time can't be from 9 crores to 20 crores or 18 crores? So I think this is definitely here to stay. And it's a coincidence that all these guys came in at an absolute right time and they have made money. The only word of caution which I would like to put here is that let us not extrapolate in our minds what has happened in the last 2 years. Because we have made tremendous money. There have been 100 to 300% average return on a lot of companies. Once you start extrapolating that in your mind, then you will definitely get disappointed. Because making money in equities was so easy, then why will any businessman do business? They will only do share market business, right? Because when I put the money in a company, I make only, if I'm a good company, I make 18% ROE. So how come some entrepreneur who is making 18% ROE will allow you to make 200, 300% return on his own stock? So we are back to basics, we are back to stock specific, we are back to reasonable returns. And be prepared, because after so much money is being made, as Nilesh Bhai said, be prepared for the volatility. You may call it Agni Pariksha, you may call it volatility, you may call it a routine test of the market, but be prepared for it, basically. It could come for any reason, it could come for global, local, oil price, etc., etc. But the fact is, we will always tend to go to mean to reversion, right? If so much money is being made, there is a possibility, and that is what history has taught us, that there is a possibility that there could be some hiccups down the line. But personally, if you ask me, if that hiccup were to happen, I am only the buyer for Indian equities from a 5-7 year perspective.
Are you fully invested in this market, apart from little bit
भाई
cash here
हमको
or
तो
there?
कुछ आता ही नहीं है, और fully invested, little leverage, but sensibly, I would say.
Mr. Jain, there is inflation. Inflation means that future returns will get compromised. When inflation is making a comeback, my simple question, which I personally want to understand, and perhaps everybody in the audience wants to understand, how can one protect your portfolio in a rising inflationary scenario?
No, Nikunj, actually equities are a hedge against inflation. And I mean, as you know, the Sensex has delivered returns in line with the nominal GDP growth. And that means real plus inflation. So I think if you are expecting high inflation, reasonable inflation, I don't think the equity investor has to worry. It is on the other hand the bond investors who have to worry, because bond prices could come off. So I don't think I would worry too much about that. But if I may go back to your earlier question and maybe give an alternate point of view.
About praising media?
No, about the retail flows. See, most of the participation by retail has been through F&O, bulk of it. And yes, you can see it on the stock exchange volumes. And it is common knowledge that F&O by definition is a zero-sum game. It is actually a negative-sum game if you eliminate the transaction costs. And recently there was a very good study by ISB in tie-up with NSE. And it suggested that 95% of, or thereabouts, of direct trades have ended up losing money. So I think on the whole, equities have done well, and especially money that came in the COVID lows. But I would not be so optimistic on the continued buoyancy of retail flows. Indirectly, I mean, the SIPs will continue. SIPs, I don't think we have to worry. As Nilesh said, that's a habit well ingrained. But this direct participation, I don't think will end like this, because you started off making money, and as the positions have only increased and number of people have increased, and by definition, it's I don't think people are making money. So I would not be so optimistic on that. And also, if you look at the quantum of flows, it is quite large. The Indian mutual funds are collecting roughly 3 lakh crores a year, right? That's 40 billion. That is 13% of household financial savings. And if you assume a likewise number in the maybe or direct or half of that, so almost 20, 25, 30% of financial savings are getting into equities. I think that does not leave too much on the upside. And also we have experienced time and again that the majority is not able to make money in equities. So whatever the majority does over time, it has proven to be a losing bet. So I would be slightly cautious, at least on the direct participation, though I do feel quite optimistic that the SIP is here to stay and grow probably.
So let's look at past returns and then extend it with future returns. We've had decent returns in last 2 years, but if I look at the last 5-year return and 10-year returns, the returns have been below average. So even if the starting point is today, 21st of April 2022, for next 3 to 5 years, is there not a possibility, but a strong probability of a double-digit CAGR return, 3 to 5 years?
No, I think there's a very strong probability. If you invest sensibly, if you don't take leverage, I think there is every reason why you should make money, because India's nominal GDP should grow between 12 to 16%. And I mean, valuations are slightly expensive, maybe 10 or 15% above longer term averages. But that still means over 3-5 year periods, you should end up making near double digit kind of returns.
And I just want to put a data here. Mr. Jain has been managing the same scheme for last 25 years, and his CAGR return, if I look at in last 25 years, is more than 100x, which means if you invested 1 lakh rupees 25 years ago, which none of us did here actually, but if you invested, which you did by the way, right? Your money is actually 100 times, more than 100 times. But the gentleman on my left side has identified a lot of stocks where money has gone up 500 times, and that's Madhusudan Kela. Now Mr. Kela is called as the market maverick. That's what I like to call you, because every time you come on a public forum, you will tell people how to invest, and more importantly, where to invest, and how to invest in which stock. So that was an open-ended question. Now you'll have to give me the answer.
So Nikunj, just to again clarify to Prashant's point, I did not mean that this 9 crore will become 18 crores in next 1 or 2 years. I mean in a longer term horizon, because there is no real alternate to equities. That is what will happen. So, this volatility. In fact, if you look at what has happened in corporate India, specifically in the last 2 years, 2-3 years, it's been a tremendous cleanup. A lot of companies have made a lot of money, and the leverage on the balance sheet of companies have actually come down considerably. If I look at last 5-6 years, the competition in a lot of sectors have actually receded very, very significantly. So the people who have very, very good, strong balance sheet, I don't think there is a real dearth of opportunities for those companies, and subsequently for investors. So you have to just do your work properly. If you have done your work, if you are bottom-up investors, I would be very disappointed if I did not make higher teen returns in my portfolio in the next 5 years.
About CAGR return.
CAGR return.
So where do you think there is possibility of this kind of a return? I mean, for stock prices to go higher, I'm just using it for the benefit of our audience. Just remember this simple thing. Market price is a function of EPS into PE. So where do you think earnings will go higher, and where do you think PE will expand?
So Nikunj, I think again, I'm not trying to evade the question, but
I will not let you evade the question.
I would hate to say a particular sector, because ultimately, even from that sector, you have to buy companies, right? Because if you identified an auto sector 3 years back, but if you bought the worst company, that doesn't mean that you have done well. So you have to ultimately be able to buy companies. So the maximum opportunity I see in the next, let's say 5 years, is all this manufacturing China plus story. Basically, I think it is here to stay. Our costs have become very, very competitive. Let's say you talk to companies like Dixon. So this manufacturing was not possible in India 5 years back, but they are now talking that maybe we are 2-3%, 4% away from China, including the benefits of PLI scheme that the government has announced, and that covers wide range of sectors. Basically, if you are able to find companies which are domestically doing well, and there is also a large export opportunity. And Then, just give you again an extreme example. Look at like the EPC companies, for instance. The total market capitalization of all companies put together is less than 50,000 crores.
All the entire sector.
All the EPC companies put together, X of Larsen and Toubro. Now, this is a hated world today because no one has made money in the last 15 years. But that is where you make money when the whole world hates it. That is where the gems are hidden, right? So, I, for individual investor, would like to really search, are there real companies? And there is no doubt that the government over the next 2, 3, 4 years will invest enormous amount of money on the infrastructure, right? Which is already happening. So who is going to do it? And if you see the sector, how it has evolved in last 10 years, there are so many companies which have disappeared. So obviously competition to that extent is lessened. So I would say, दोस्त ये buffet लगा हुआ है. आपको क्या खाना है और आपको कितना खाना है वो अपने हिसाब से चूज करो. इतना मत खाओ कि इंडाइजेस्ट हो जाए.
So, नीलेश भाई, आप बुफे में से क्या खा रहे हो?
मेरा तो निकुंज भाई सिंपल है. मैं लोगों को बोलता हूँ आपका पैसा कोटक म्यूचुअल फंड में लगाए, अपना पैसा भी वहीं पे लगाता हूँ.
तो मधु भैया, you have given money to Kotak Mutual Fund or HDFC Mutual Fund?
I think I'm still able to manage on my own.
नीलेश भाई, Kotak Mutual Fund के बाद आप रुक गए.
सॉरी,
You stopped that, put money in Kotak Mutual Fund and nothing after that.
बस यही है. यहीं पे दुनिया शुरू होती है, यहीं पे दुनिया खत्म होती है.
वो पूछ रहा है कोटक म्यूचुअल फंड कहाँ लगा रहा है पैसा.
See, this is the challenge for me. Now Madhu Beria can ask questions like me, so I can really see competition coming also from the other side.
I think overall India growth story is good. And we want to invest in good companies at good prices. Very easy to say and very difficult to execute. As of today, we are bullish on pharma sector. We believe there the undervaluation will come into play and earning as well as PE both will get upgraded. As Madhubhai mentioned, we are also bullish on industrial and capital goods along with PLI and China Plus One. That's kind of a combined manufacturing theme. We believe what we haven't seen in past in terms of manufacturing capabilities, we should be able to see going forward. If you look at India's mobile phone sector, we were importing about $8 to $10 billion in 2013, 14, 15. There were 3 factories making mobile phones and total domestic production was about 22,000 crore. Fast forward to 2022, there are more than 200 factories making mobile phones. Domestic production value is up 12 times to 220,000 crore. We are exporting mobiles of about $5 billion. From being 12th largest mobile phone manufacturer, we have become 2nd largest mobile phone manufacturer. What happened in mobile phone will happen in many other sectors, courtesy PLI schemes, courtesy manufacturing becoming competitive, and that will create this sector on a next probably multi-decade bull run.
Nikunj, just put this PLI into context. The government has said that they want to give 2 lakh crore rupees of PLI. That's roughly 5% of the turnover, which effectively means companies will have to do 40 lakh crore rupees of turnover to avail this 2 lakh. Mota moti math. Don't hold me for a specific number. So, mota moti math is that 4 lakh crore rupees of 40 lakh crore rupees of turnover will have to happen for me to avail 5% on the PLI scheme. If I do 40 lakh crore rupees of turnover, on an average of say 15% EBITDA, including good, bad, ugly, right? You're talking of 6 lakh crore rupees of incremental EBITDA happening only because of PLI schemes.
That's like the big theme really to cover to.
And that is all likely to happen in the next 5 years.
So my next question would be an extension of pretty much of where are you investing right now. The value part, Mr. Jain, in the market in last 1 year has seen a comeback. NTPC, Coal India, manufacturing stocks? Where are you picking your spots in the market?
I think the Indian markets are not cheap, but
They are not cheap.
they are not cheap, and on an aggregate basis. And but given the growth prospects here, and one thing I would like to point out is, unlike 10 years back when many sectors were facing regulatory challenges, today you don't see any headlines around regulatory challenges. So I think the investment outlook, the growth outlook in India is quite robust. And with that background, I think this 10, 15, 20% overvaluation is not too much of a worry. The sectors that I find are expensive, and this is a very personal opinion, I think is basically consumer. The entire consumer space, I think, is quite expensive. And even the technology space, the IT services space, I personally feel is very expensive. And most other sectors, I think, are fairly valued. I think banks should benefit over time from interest rates going up, from higher inflation, and from credit growth picking up. The NPA cycle is behind us clearly, but I think the loan growth cycle is ahead of us, the capex cycle is ahead of us. So I think they are attractively placed. I think one space which to my mind looks quite cheap, at least in a historical perspective, is the power space. And I think everyone has hated that space. And I think India has underinvested, like the world, in fossil fuels. But as we are realizing today, there are limitations to the speed at which you can transition from traditional to renewable sources of power. So I think that space is still offering quite good value to my mind.
So a couple of last questions, and a very basic question. When you read a headline which is about geopolitical war, energy crisis, inflation going higher, demand is going to drop, just nothing is going right for an equity investor, why should we not expect a sharp drop in the market or a sharp fall or a market crash?
See, corrections may well happen, but I don't think, because of what you said, it would be, to my mind at least, I would expect a correction, because the Indian economy, despite having opened up materially over the last 3 decades, fortunately it does not depend too much on developments outside India. And the best example of that is that when Lehman took place, that year the economy still grew 5.5%. So I think we have a great demographics, good regulatory framework, very supportive government, and a very favorable investment climate. And I think for the first time in my career of 30 years, India has gained competitiveness over China in cost of manufacturing. So I think in services we have less competition. In manufacturing we should be able to increase our share. So I don't think what is happening in Ukraine, it's very unfortunate, but I don't think it really impacts India that much. India is quite self-sufficient in food grains. The only place where we could get impacted is oil imports. But let us remember that way back in 2008, oil had crossed $100. And at that time, the software exports were much lower than the oil imports. And today at $100, the situation is much better, because today our software exports are materially higher than the oil imports. So over time, India's resilience to handle even higher oil prices has improved. And probably that's the reason why, despite the spike in oil prices, the currency has been remarkably stable. So I think we need to distinguish between disturbing, unfortunate headlines and what is the economic impact of those in India. I think the profit cycle is quite good in India. There is broad-based recovery in profitability. Corporate balance sheets are extremely healthy, as Madhu pointed out. And even bank balance sheets are extremely good.
So I'm just nearing the end of the discussion. I've shamelessly extended my time. So if I just wrap the essence of today's discussion for the benefit of attendees here and for those who are watching home, is that this panel feels that we are in for, there's a probability and a possibility of a double-digit return from next 3 to 5 years. You have to invest in equities at this point in time, because that will be a hedge against inflation, manufacturing, cyclical. There are a lot of themes which this panel is bullish on. But you always have time for one question, and I'll throw it to Mr. Kela. And, I've had the pleasure of meeting and interacting with him on a personal level for over 20 years now. So, Madhubhaiya, my question is that you got two lovely daughters.
Sorry?
Two daughters. Yeah. Not as a father, but you're sure your daughters would be asking you, at least your elder one would be asking you questions about investing. So what is Madhusudan Kela, the investor, telling his daughter about investing?
So, unfortunately, my elder one is only interested in arts, so she doesn't ask me the... But the younger one is quite curious. She is only 14 years of age. And whenever time permits, she catches me, and I try to explain to her that you are born at such brilliant time. You are born in a country like India, and the world is waiting for you. Believe in the country and invest in equities.
I thought you'll say, give money to Prashant uncle or Nilesh uncle, not to Papa.
No. I would say be Atmanirbhar.
All right, ladies and gentlemen, it's just been wonderful interacting with Nilesh Bhai, Madhu Bhaiya and Prashant Jain. Thank you all very much. Let's put our hands together for this lovely panel.
Thank you so much.